Hey guys, how's it going? Hope everybody's enjoying their weekend. We're going to start here very soon. Okay, as always, we want to make this session as interactive as possible. So we're going to shoot today for 30 minutes of me presenting and then 30 minutes of Q&A. And also, if you have questions before then, feel free to type them in the chat, the YouTube chat. I will look and answer as best as I can. And the questions that you guys have don't necessarily have to be about what I'm presenting. They can be about anything. I'm here first and foremost to help everybody here with whatever questions they have. That is the benefit of being live. And so that's that. We're going to talk about today the benefits of trading options versus stock, how much leverage options give you compared to just buying shares of stock, and how much more actual power you get per dollar by buying option contracts instead of buying shares of stock. Well, that's weird. For some reason in presentation mode, this font doesn't show up. So I will zoom it out and do it this way. So here's an example here of buying shares of stock versus buying an option on Microsoft. And what this example is doing here is we're giving an example of buying 1,000 shares of Microsoft or buying 10 contracts on Microsoft. And what 10 option contracts does is it also gives you control of 1,000 shares of Microsoft. So every one option contract gives the buyer control of 100 shares of the underlying, in this case, Microsoft. So here, if you wanted to buy 1,000 shares of Microsoft, you would have to pay almost $66,000. Whereas if you wanted to buy 10 contracts on Microsoft, giving you the same control of 1,000 shares, you only have to pay $650. This right here is a perfect example of how much leverage you get when trading options and why you can make so much money so easily. The way that this works is a 5%. If we take a 5% move in Microsoft and it moves to 67.19, you will make $3,000 off of your 650 if you're trading options, or you would make almost 3,300 off your 66,000. So you can see right there how much more you would make per dollar when holding the option contracts instead of the shares of Microsoft. And you're also risking a lot less. Now you're not actually, unless Microsoft goes bankrupt, and if you buy 1,000 shares of Microsoft, the only way you're going to lose your 66,000 is if Microsoft goes bankrupt, which probably isn't going to happen, anytime in the near future at all. So you're probably risking less than 66,000, but the real point here is that you're making almost the same amount with your $650 as you would if you put up 66,000. And this is a perfect example of how option contracts give you so much leverage for a fraction of the cost. And it also works the other way as well. Options are a double-edged sword, so you could easily lose your 650. And where, like I said, if you buy 1,000 shares of Microsoft, you're gonna lose a lot less as a percentage of your investment. Where if you pay $650, you have a better chance of losing everything you put into that option. But it's a double-edged sword. You also have the upside as well. See if does anybody have any questions? Okay, I don't see any questions yet, so I'm going to keep going. So it looks like we have 8 people now. If anybody has questions as I go, please feel free to type in the chat. As I was saying to the people we started with, the benefit of this live stream is to be as interactive as possible. So hopefully I'm only presenting to you guys for 30 minutes, and the other 30 minutes we can interact. So right here is a screenshot of an option chain on Microsoft. And what you see here is the 66 strike call is 65 cents per contract on the ask. And what that's showing us is just the example of how much leverage we're getting here, where we are. Yeah, so this is what it looks like on the option chain. If we're buying that 65-cent call on Microsoft with the 66 strike and an April 21st expiration. Okay, good. Now this is coming up in present mode. That's weird that it wasn't at first. So yeah, this is what the option chain will look like on Microsoft if we're buying that 65-cent call. And the way that works is it's quoted as 65 cents on the ask. So the bid ask is 62 by 65. It's quoted per one share within the option contract. So you're actually paying, you have to move the decimal over twice because you're multiplying this by 100 because you're getting control of 100 shares per option. So you're actually paying $65, not 65 cents. You're paying 65 cents per one share within the contract, and there's 100 shares in that contract. So this is what the option chain would look like. Okay, so now there's also a way to calculate your break even at expiration. And how to do that is you take your cost at 65 cents and you add that to the strike, which gives you 66.65. So at expiration, you need Microsoft stock to be at 66.65 to break even on your calls. And every penny Microsoft goes past 66.65, you make $1 per contract profit. And the way I always think of it is you are almost 1-to-1 for a fraction of the cost, whereas you'd have to pay up a lot more dollars if you were going to buy stock to get the same benefit. This is all just giving great examples of how you get leverage when you buy options, and that's why they're such a great tool to make great gains. So if Microsoft stock is at 67, then you you've made 35 cents profit on your original investment. Because at expiration, all you need to know is how far in the money the option is to know exactly what it's worth. So this option is actually, if we buy a 66 strike call and Microsoft finishes at 67 at expiration, our option is going to be worth $1. 35 cents of that will be profit, and the other 65 cents will be our original cost. The max you can always lose when you're long an option, when you buy to open, there's two sides to a put and a call. You can be short a put, you can be long a put, and you can be long a call, and you can be short a call. So we're only talking here about being long a call. And when you're long a call, the only amount of money that you can lose is whatever you spend on the actual option. So in this example, our max loss is $65. Now, if Microsoft stock finishes at 66.25, then our option's only going to be worth 25 cents and we lose 40 cents on the option, or we lose $40 per contract. So that's basically how it works at expiration. You take the strike of whatever option you're holding. In this example, we're holding a Microsoft 66 strike call. And at expiration, however much it's above 66 is exactly what the option is going to be worth. So if Microsoft at 66.25, the option is going to be worth 25 cents. If Microsoft is at 67, the option is going to be worth $1. And in the example we gave, a 5% move in Microsoft would give us, that is a 200, 300, 400, right? It would give us a little bit over a 400% return. So with an option, if you get a decent move in the stock here, like in this example, Microsoft moves 5%. If Microsoft moves 5%, we're holding this option, we're going to make over 400%. Whereas if we're holding the stock, we're just going to make 5%, right? So it's making 5% versus making 400% and paying a fraction of what we would have to pay. That makes options so beneficial for traders. And again, we can see in this example here, we're paying $650. We're making $31.70. That's 400%. Here, we're paying $66,000 and we're only making 5%, right? So we're paying $650 and we're making over 400%. We're paying $66,000 and we're making 5%. And the actual dollar amount we make is pretty much the same. And we can see how much less we're paying with the option and what we would have to pay if we actually bought the stock, shares of the stock. See if anybody has any questions. I think this is a great example of why options are such a powerful tool to leverage your portfolio and help you make a lot of profits with a minimal cost and a minimal investment. Good morning, Manuel. How do we choose the best option from the chain? That's a good question. Let's take a look. I'll give you my guidelines that I like to use and some reasons why. And hopefully this can be helpful to everybody watching. I've also put these guidelines, I've driven these home a lot of times in the past as well. So I would say everybody feel free to check out all of our videos on Dave's YouTube channel. And we also have a couple on an Option Sniper YouTube channel. In some of those videos, I I drive this home, and every time I do a class, I try to drive home these rules that I try to abide by, and try to make sure that everybody trading options at the Santarelli Exchange will hopefully follow on their own, and eventually they can use these guidelines, hopefully, to structure trades in a less risky manner that will help them protect their capital. So I like to drive home the point of the number one most important thing is not to make money. The number one most important thing is to protect what we have and stay in the game. Our number one goal should be to protect our capital. That's number one. So that being said, what strike would I choose, Manuel? I always choose, I go by delta, right? So I recommend that everybody buys at least a 50 delta or higher. The further in the money you go, the higher your delta. So the further in the money you go, the less risky the trade is going to be. So if you buy a 50 delta or higher, you're going far enough at the money or in the money, and you're making the trade less risky, and you're tipping the odds more in your favor. Now, in this example too, this is an example of a weekly trade where we're buying weekly options on Microsoft. And we need to make sure when we're buying weekly options that we are not holding a lot of those as a percentage of our account, because weekly options are the most risky options, and it's the easiest to lose on those. So I'm going to give these guidelines again towards the end, these money management guidelines, where a weekly option means that it's expiring this Friday. So a weekly option now is the May 5th expiration. That's the weeklies. I feel very strongly that everybody should not be putting more than 3% of their accounts into weekly options, because whatever you put into that weekly option is at risk, okay? It's very possible that you could lose everything that you put into that weekly option. So you have to be ready for that, and you have to be risking small enough amounts so you can keep yourself in the game long enough and not really hurt yourself, if that makes sense. So I would say my rules here are at least a 50 delta, and I always advocate going out longer in time. I always say for beginners, if you're making your own trade, go out 30 or more days in expiration, giving yourself more time, and also a 50 or higher delta. These are the guidelines I give to every beginning trader. I say 50 or higher delta and 30 or more days in expiration. Follow those two guidelines. You're going to give yourself the best chance of success, and you're giving yourself better odds while also being less risky. But at the same time, anytime you're buying options, you're being risky enough. So, if that makes sense. All right. Okay, so to sum all of this up, this example that I just gave gives a perfect look into how options give us leverage, right? Maximum leverage with a small amount of cash, allowing us to make large percentage profits. There's just so much more benefit to trading options versus trading stock, because you have to put up way less money to control the same amount and make way more percentage-wise. There are many different types of option strategies, and we teach all types of strategies at the Cinderella Exchange: debit spreads, credit spreads, butterflies, iron condors. So yeah, there's all types of different strategies you can use, and that's why they're called options, right? There's so many different things that you can do to give yourself more exposure to the market with small amounts of money and large amounts of upside. So if you find this interesting about what we're talking about options, and you find this exciting, we always offer everyone a free first month, new users. If this is new to you, if the Cinderella Exchange is something you've never tried before, we give everybody a free 1 month trial. So what you get with that free 1 month trial is you get access to our live trading room. You get access to text alerts that Dave sends out, that we send out. These live alerts are trade alerts. We send them out through email as well as educational classes. We have an educational live session every Sunday, an hour long. And we also have traders in the chat room all day to help you with your questions during the trading week. Okay. So, does anybody have any questions? Does anybody have anything that they want to talk about? Okay, I'm going to review some slides, especially this money management one. So I want to make sure this is review. This is in a couple of our other videos, but we always want to make sure that everybody sees this slide and follows these rules to give themselves the highest probability of success. If you don't follow strict money management rules, you have a very high probability of failure. So the guidelines that we give are 3%. You want 3% max of your account in weeklies, 3% max in expiration greater than 70 days. Greater than 7 days and less than 30 days. And then 5% max in 30 plus days expiration. And I'm also assuming here that the deltas being bought are 50 plus, as you can see at the bottom. And this assures that if you lose everything you have out at once, you're only going to lose 11%, which is not the end of the world. It's not difficult to bounce back from an 11% loss on your portfolio. It is extremely difficult to bounce back from a loss of 30% or more. And if you think about it, if you lose 50%, you need to make 100% to get back to even. So obviously, the more you lose, the harder it is to get back to where you were. That's why we really want to make sure everybody follows these rules to keep themselves in the game and allow themselves to eventually profit if they do go through drawdowns. And poor money management and poor discipline is why all traders fail. Not all traders, but poor money management and poor discipline is the number one reason why traders that fail. And the success rate of actual people that make it in trading is low because most people fail to do this. Okay? So if you can follow these rules and stay disciplined, you give yourself the highest chance of success, and you will succeed if you can do that. So we can look now at some charts. I can pull up stock charts and give my analysis of the market. Does anybody have any other questions? I don't see anything else. So let's take a look at stock charts. So if you guys are new watching this, you've never heard of stock charts, it's a great free site. This is kind of the homepage. We always do our analysis on the S&P 500. That gives us an outlook on the overall market. Now, what we do here at the end of every week, we check the weekly candles as well. It gives us an even better picture of the market longer term. And we don't use a lot of indicators. Price is our main thing that we use. But one thing that I do like to use is a MACD that's a lot more responsive. The parameters I like to use on my MACD are 3, 10, 16. The 50 and 200 SMAs, simple moving averages, are very important always to be aware of. And then my short-term moving average that I always use is the 17 EMA, the exponential moving average. So we can see here on a weekly time frame, it's possible we are getting close to breaking out. We need to close above this 2400 level to really start making the next leg up. We had been chopping for 7 weeks, and now it's finally looking like it's possible that we can break out. Now, this was a pretty explosive move up. It's possible also that we go sideways a couple more weeks before we actually eventually head higher. And there was something that happened on Friday that really led me to believe more that it's possible that we go lower, at least into the beginning of this week. And that really has to do with small caps. Small caps were very weak on Friday, a huge down candle, and usually there will be some follow through with that. This really has to do with what's going on now in politics. Trump made the tax reform announcement on Wednesday. In my opinion, it was a very underwhelming tax plan. It doesn't really help the people that need the help the most. All it does is cut taxes for businesses, which can be good for the economy, but the people that need help the most, in my opinion, are still not getting enough help. So the market didn't really like the tax reform announcement on Wednesday. And the other reason is GDP on Friday was lower than expected at 0.7%. So a couple things going on with the market that don't seem so bullish right now. With all that being said, last week we gapped up, right? So we closed 2 weeks ago at 2348, and we made a high of 2361. So we closed 2 weeks ago at 2348. The next Monday we gapped all the way up to 2370. And this was driven by the French election results over the weekend. The two finalists that were expected to be the two finalists happened, right? So the polls were correct, the predictions were correct, and the market, for some reason, really reacted positively to that. So that kind of drove the rally in the beginning of the week, but the market did tail off towards the end of the week. Pretty much once the tax reform announcement was made, the steam kind of came out of the market. And even with earnings, right? So on Thursday, Amazon, Google, Microsoft all reported earnings. And on Friday, well, Google and Amazon both gapped up huge, but Amazon sold off really hard on Friday and barely actually closed up from where it was. And Google closed significantly lower than from where it was as well, although they both closed positive. But even with these big tech companies reporting good earnings, the market did not really do much on Friday. The market was pretty weak on Friday. So there's all that. But on the weekly time frame, we are really overextended these last 2 weeks. So I would expect at least some sideways movement this week before we eventually attempt to head higher and break out of 2400. I don't see us breaking out of 2400 this week unless something substantial happens news-wise. And we do have non-farm payrolls coming up this Friday. It's the first Friday of every month. So there is that. But like I said, we are very overextended. It could be a couple more weeks before we break out in either direction. And we have had a large move to the upside. So that's the weekly time frame. Looking at the daily, like I said, Friday was a decent move down on Friday. But we did gap up the beginning of the week, and then we chopped sideways. Now, the thing, in my opinion, everybody should always be aware of is small caps. Small caps have really led this rally in the market since Trump was elected. Small caps really took off. Small caps in the beginning of the week led the way, broke out. But on Friday, we had this very, very, very strong move down. And in the IWM, at least, I'm expecting follow through on Monday. You don't usually get a big candle like this without follow through, right? So we closed here. Now, this is the first candle where we closed below the previous day's low. Usually, there's at least one more day of follow through here when you get a big candle like this. So I'm expecting the IWM to trade lower at least on Monday. This is what makes me going into next week bearish, because the IWM looks so weak, small caps look so weak. Also, transports were pretty weak on Friday as well. The Dow transports were down 1% as well. They're not holding up very. Dow transports are actually below the 50 SMA now. Closed Friday below the 50 SMA, which is also not good. You also want to see the transports being strong. You always want to see transports and small caps strong if you're a bull. You want to see them helping lead the rally, if anything. And they're both looking like they broke down on Friday. And actually, on this MACD here, we got a bearish cross on Friday. If you can see this black line crossing below the red line and these blue bars crossing down to the negative side, this is called a bearish cross on the MACD. So we will see if we get more fall through on the transports. The ETF for it is the IYT. I would say there's a high chance the transports and IWM, IYT and IWM both trade lower on Monday, and which leads me to believe that the market, at least the beginning of next week, will be weak. Anyone have any questions? I don't see any questions, so I'll keep going here. Okay, so after looking at the indexes, we always need to be aware of what bonds are doing as well, what interest rates are doing. This gives us a whole picture of the market. If people are buying bonds, then that's generally seen as bearish, because when people put their money into bonds, they want to put their money into something safe. And when you're bullish, you want to see the TLT going lower, because you want to see money coming out of bonds and rotating into the market. Well, what happened on Friday is the TLT had a pretty strong up day, so rates went lower. And when rates go lower, that's also bearish. And then commodities, gold. Gold had a slightly positive day, and it's looking like it's possible that it's ready to start to get going again to the upside. So that's kind of what I do when I look at my analysis. I start with indexes, I look at bonds, I look at commodities. This gives me an overall idea of general picture of the market. Sometimes it's neutral, sometimes it's bullish, sometimes it's bearish. In this case, to me, it's short-term bearish, the price action we got on Friday. So we will see how that plays out. And then that's after I look at all the indexes, I will drill down and look at specific stocks. So always interested to see what Tesla is doing. It's a great company to ride lower when things sell off. Tesla was actually positive on Friday. So yeah, this is kind of how I do my analysis, and also always being aware of the VIX as well, which did move up slightly on Friday, but is still super low. Anytime the VIX is below 11, that's like ridiculously low, and anything time it's below 12, that's super low. So anything below 12 on the VIX is bullish, is really bullish. Once we get above 12, things start changing a little bit. But right now, it's really the fear gauge in the market, the fear gauge in the market, and there's really no fear, right? Anything below 12 is saying, the market's not really worried at all about anything, which is bullish, longer term. But that being said, when the VIX is this low, it's also the best time to be buying puts because implied volatility is lower. So there's that as well. And there was something else I was going to look at. Can't remember off the top of my head. Let's see here. Oh yeah, key levels on the S&P 500 that everybody should be watching this week. 2400, of course, to the upside is that big resistance level. We did test it way back on March 1st, and we kissed it that day, and we came back down and never got close to it again. And now we're getting pretty close. So 2400 to the upside. If the S&P can close above there on the daily, that's a huge bullish confirmation. And to the downside, right here, the high of this candle, 2375. The 2375 level is really the most important close level, and then the 50 SMA. So 2375 and then 2363 to the downside, and of course that all-important 2400 level to the upside. These are levels that everybody should be watching this week. Whichever way we break those in either direction will give us confirmation that it's possible we can move more in either direction. But as long as the S&P can hold the 50 SMA, we should head higher over the medium term. So as long as the S&P stays above 2363, I will remain bullish medium term. And like I said, short term, I think we're due for a little pullback. But as long as we can hold the 50 SMA on the S&P, we'll be fine. Longer term and medium term. So that's my outlook on the market for the coming week. Does anybody have any questions? I don't see any questions. And there's not much more for us to talk about today. I would highly recommend that everybody checks out all of the videos on this channel. And also there's 3 videos on Option Sniper channel. So we do have a lot of content, and I would strongly recommend watching the money management course if you haven't yet, and reviewing everything. These videos will be very helpful, especially for new traders. And there's some cool stuff for even intermediate traders to advanced traders as well. I did talk last week about Expiration Friday, so that's kind of a more advanced topic. So I'd recommend checking that out if you haven't yet. And I talked about the Ichimoku Cloud last week. And before that, we really went hard into money management because that has been the underlying issue that we've seen for newer traders and most traders at the Santa Rosa Exchange is money management and discipline. So we're really making a point to drive that home, how important that is. And like I said, we've laid out these rules for everybody to follow. I will share these slides in the chat. As always, we always share these for everybody to review. Please, please, please follow the rules on this slide. If you follow the rules on this slide, you will be successful. I have no doubt that if you follow the rules on this slide, you stay with the Sand Relay Exchange, you stay with us, you will be successful. So that's pretty much it for today, guys. Does anybody have any questions? I would have liked to see more questions, and I'm still happy to answer them. And it can be about anything, guys. I'm here to help, so please, please, please ask away. But if I don't see any questions here in the next couple minutes, we're going to call it a day. I'll give it 2 minutes. So Joe, the code is in this PowerPoint. I will share the PowerPoint. Joe, are you already in the chat on the Sand Relay Exchange? Okay. And you didn't enter that promo code, is what you're saying, right? You can ask Dave about that. Maybe he can help you with something. If you just recently signed up, maybe there's something he can do to help you. I'll let him know about that as well next time I talk to him. And hopefully we can do something for you. Yeah, I will let him know. When did you sign up? A couple days ago is fine. We should be able to help you out with that, Joe. For sure. No problem. But for anybody watching, if you possibly have not signed up yet, you enter the promo code free at checkout, and you will get a 1 month for free. Okay, so you signed up. You're halfway through a month. Hopefully, yeah, he should be able to hook you up with something here, Joe. Hope you've enjoyed your first 2 weeks as well. Hope you're learning a lot. Do you have any questions, Joe? Anything you're struggling with? Anything you need help with? So, Joe, yeah, Dave bought DIA puts. I see that question. Dave bought puts on DIA on Friday. I would say if you haven't yet bought them, Monday may be too late, but it depends on what happens on Monday. If the market sells off on Monday and we close below Friday's lows, then it's possible that Dave could be adding more to those DIA puts. Dave and I were on the same page last week. We both ended the week with the bearish stance. I picked up some puts in IWM, and Dave picked up puts in DIA. So I think we both have the same kind of outlook entering this week. And yeah, I will let Dave know about that. So, and then for the DIA puts, I would say Monday would be too late, but wait and see how we close on Monday, and it's possible that could be a trade heading into Tuesday. But a lot of the time on Monday, we don't really want to make a lot of decisions, especially the first couple hours. We want to wait and see what happens. And I say even to wait until the last hour if possible. It's the best time to make any decisions on when you're going to make some trades on, especially on a Monday. And so, yeah. So, all right, guys, that's going to be it for today. Everybody enjoy the rest of your Sunday. Hope this presentation was helpful.